Mm. Hello, everybody. I wanted to talk to you guys today about this addendum. It's called the Assumption to Financing Addendum, and it's addendum to the purchase agreement that you would use when the seller has an assumable loan and your buyer is looking to take over that loan when they purchase the property. Most of the time, this happens when a seller has a very low interest rate and the buyer wants to take advantage of that lower interest rate and then either pays for cash for the rest of the amount that they need to buy the property or will get a mortgage for the rest of the amount. Now, there's lots of ins and outs with assumption financing and how all that works, but it is becoming more popular in our markets because of the very low interest rates and because of sellers who are needing who sell. They can't hold on to those wonderful interest rates. So when you have a buyer who's looking to assume the seller's current mortgage on the property, this is the addendum that you use when you are asking for that in the purchase agreement. Now, I will say at the beginning of this, there are assumptions that are made when we're filling these out. Okay. If you can get more information from the listing agent and the seller to be able to fill these out more accurately, that's always better. But it is when you are writing this offer up for the buyer, you are making assumptions with all of this. And then when you send it to the seller and the listing agent presents it to the seller, they will counter if any information is incorrect in here. Okay, so keep that in mind as the listing agent. It's your job to counter any wrong information in these addendums. Okay, okay. First things first, line one is the date. The date you're filling this form out. Line three is the addendum to the purchase agreement between parties dated blank. This is your purchase agreement date, the date that you're filling out the purchase agreement. Okay. Pertaining to the purchase and sale of the property at blank. This is your address, right? We all know those things. That's easy. Line number six, buyer assumes and agrees to pay according to the terms and conditions the following. Lines 7 and 8 and 9 are talking about the current mortgage that the seller has on the property. It says that certain mortgage in an approximate principal amount of blank, you fill in an amount here. Let's say it's 200,000. Okay. Now, this is the amount that is left on that assumable loan. This is not the purchase price. The purchase price could be 300,000, but 200 of that is part of this assumable loan. Okay? So this is the assumable part. Line number 8 is in favor of. This is the mortgage company. So let's just do Mr. Cooper, right? It's a big old mortgage company. This in favor of is who holds the mortgage, whoever it is. For those of you who don't know, Mr. Cooper is a mortgage company, not an actual person. He might also be an actual person. That's beside the point. Line number 9, with a current interest rate not to exceed blah percent. Usually this is going to be fairly low. This is going to be different than the market percent that your buyer is going to get if they go get just a mortgage. This is going to be the current interest rate on this particular loan that the buyer is assuming. Okay. Then line 10 and line 11 and line 12 are talking about contract for deeds. 99% of the time when you fill out this addendum, line 10, 11, and 12 are going to be zeros. Okay, because most of the time there is not a contract for deed on the properties that we're selling anymore. The holdover from the before times when a contract for deed was fairly normal. So what this says is that certain contracts, contract for deed, in an approximate principal amount of, you would put in whatever's left on that contract for deed. If there isn't one, you put 0. With a current interest rate not to exceed whatever percent that contract for deed is. If there isn't one, you put 0. And then I'm going to back up here because I went too fast. Now, line number 12 talks about the total amount of the financing assumed. Okay, so you're going to put the total amount based on these two numbers. Keep in mind, this is not the purchase price. This is the total amount of financing your buyer is assuming from the seller. So in this case, it's line number 7 plus line number 10. That's $200,000. Okay. Hope everybody's with me so far. Now, the this part, line 13 through 22, is talking about what happens if we assume there's $200,000 left on that assumed mortgage. We're buying the property for $300,000. So our buyer has to come up with $100,000 extra to be able to purchase the property, right? They're assuming the $200,000 mortgage. They have to come up with $100,000 more to get to that $300,000 purchase price. In the case that we are assuming that the principal amount of this mortgage is $200,000 and the buyer is paying cash or going and getting a second mortgage for that extra $100,000, this is a clause that limits how much this number can change. Okay. And if it changes enough to the point where your buyer has to bring a significant amount of cash to closing or has to go get a mortgage for a significant higher amount than what they originally thought, then they are able to cancel this purchase agreement and retain their earnest money. This piece is why it's important that you use this addendum. Because I guarantee if you write this in the other category in the purchase agreement, that this is contingent on the buyer assuming the loan from the seller, that you're not putting this language in here. Now, I'm going to do a whiteboard to show you guys exactly what I mean here. And then we'll read the document. Okay. Okay. I got to move this over here, I think. There we go. So let's say the purchase price is $300,000. I'm getting pretty good with my mouse and writing on the computer screen, so that's fun. The assumed loan, this is being assumed from the seller, is for $200,000. Okay. So the buyer is left with $100,000 deficit. Okay. This amount they have to either have in cash or a second mortgage. Okay. I'm sure there are other ways to do this, but these are the two most common ways. Okay. They're assuming the $200,000 loan, purchase price is $300,000. They need to come up with $100,000 one way or another. Now, this $200,000 is what's assumed to be left on that assumable mortgage. Okay. When you then get closer to closing, you will get the actual number, okay, of what is left on that assumed loan. If that actual number is less than 98% of this, then the buyer has the right to cancel the loan because they would have to come up with more cash or second mortgage to be able to buy the property. Okay. So let's say we have a $300,000 purchase price. Okay. When we wrote the amendment or addendum, we put $200,000 in there because that's what everybody thought it was. But it's actually 175,000, not 200,000. That's a $25,000 difference, right? That means that this is less than 98% of this assumed amount that we assumed when we filled out the purchase agreement. So the buyer now has a $125,000 deficit, and that buyer may not have that extra 25,000 to be able to come up with cash to close on the property. Or that might kick them into a different mortgage category or put their debt to income ratio over with that extra 25,000. They might not be able to get that second mortgage, right? So in this case, your buyer would have the right to cancel the purchase agreement. That's what this addendum is talking about, or this piece in the addendum. Okay. All right, now I got to figure out how to stop sharing this. There we go. And we'll go back to my screen. So let's read this part real quick. The exact unpaid balance of the mortgage will be determined as of the date of closing, and any difference between the actual mortgage and the amount stated in this agreement shall be adjusted in cash at closing, so the total purchase price will remain the same. So like I said, if that amount is less than $200,000 for the assumed loan, the buyer will have to come up with cash to be able to close on the difference, okay? If at closing, the actual mortgage balance, I'm skipping over this contract for deed part. The actual mortgage balance is less than 98% of the approximate amount of financing stated in this purchase agreement. Buyer may, at buyer's option, declare this purchase agreement canceled by written notice to the seller or licensee representing or assisting seller, in which case this purchase agreement is canceled. So again, if the amount that you're given at closing for that assumed mortgage is 98% or less of the amount that you've put in on line 7, then your buyer has the right to cancel the purchase agreement. They don't have to, but they can. Okay. Then goes on to say normal cancellation language. If buyer cancels the purchase agreement, buyer and seller shall immediately sign a cancellation of purchase agreement, confirming said cancellation and directing all earnest money paid here to be refunded by buyer to buyer, unless any costs incurred as a result of the assumption application. However, buyer may, at buyer's option, proceed with this purchase agreement regardless of the actual mortgage amount. Okay. So your buyer can cancel if they want to, but they don't have to. The next piece, that one was a little confusing, so I wanted to make sure we worked through it quite well. If you have any questions, please let me know. The next piece, 23 through 28. In the event the mortgagee requires approval of the buyer as a condition for allowing the assumption, buyer agrees to make application of said assumption within 5 business days of final acceptance of this purchase agreement. If buyer does not qualify for the assumption of the mortgage, or if the interest rate is changed to a rate greater than the rate set forth herein, this purchase agreement is canceled. Buyer and seller shall immediately sign a cancellation purchase agreement confirming said cancellation and directing all earnest money paid here to be refunded to buyer, less any costs incurred as a result of the assumption application. Okay. What this piece is saying, most mortgage companies don't just allow somebody else to assume a mortgage. They have to verify that that person has income, has the debt to income ratio, to be able to assume that mortgage. Okay. That's what this piece is saying, is that if the mortgagee, which most of them do, requires approval, the buyer's going to ask for that approval, make an application within 5 business days of final acceptance. So that's something as a buyer's agent you need to be paying attention to make sure that the buyer is getting their application in as soon as possible. As a listing agent, that means that you need to have contact information from your seller about who needs to be contacted for this assumption to happen. Okay. Line 29 um, talks about assumption fees. Some banks charge a fee because it's a lot of paperwork, it's a lot of documentation for somebody else to assume a mortgage. Okay. In this addendum, the buyer agrees to pay the assumption fee not to exceed a certain amount. I would suggest you talk to your lenders to see what this amount should be. Our best guess is anywhere from $1,500 to $2,000. It might be more depending on the bank. Okay. It might be less. This amount doesn't have to be exact to what the assumption fee is, but if the assumption fee goes over that amount, then the buyer needs to go back to the seller and say, hey, this isn't going to work. I don't want this. Or the buyer can just go through with it if they're okay with it, right? If it's $7 over, I'm sure they're fine. Use your best judgment. Line 30 through 32 talks about unused escrows. Okay. This is another thing that I think agents forget about when they make their offer contingent on assuming the seller's mortgage. Line number 30, starting with line number 30, says either buyer agrees to reimburse the seller or seller agrees to transfer to buyer any portion of unused and reimbursed escrows at time of closing. Seller certifies escrow deposits will be current as required by the lender as of date of closing. So I'm sure all of you know escrow is used to pay taxes and insurance, and it is tacked on to your monthly mortgage amount that you pay every month. They're usually the seller, when they sell a property, they will get the unpaid escrow balance back from their bank in a check or a direct deposit. Okay. This talks about what happens to that escrow account. The buyer can either reimburse the seller themselves for what's in that escrow account, or the seller can be super nice and agree to transfer whatever's left in the escrow account. As a buyer's agent, you would want the seller to agree to transfer to the buyer every bit of it, right? As a seller's agent, if you are getting an offer with this assumption financing addendum, you need to watch this line for sure and have a conversation with your sellers on whether they care what's left in the escrow and whether that comes back to them or they're fine just handing it over to the buyer. Everybody's going to be a little different, so I can't tell you which way is the right way to go. That's why it's a checkbox option. Okay. Then line 33 through 41 is some more assumptions that we need to handle, right? Seller warrants that the present financing is, what is it? Okay. Then seller warrants that the present financing, is what type of interest rate and payment schedule? Is it a fixed rate? Is it adjustable? Is it a graduated balloon payment? Is it something different? Okay. You might not know these right off the bat. Use your best judgment. If any of these are wrong as a buyer's agent when you fill out this addendum, it is the listing agent and the seller's responsibility to counter back to you to give you the correct information. Okay. Line 41 talks about the present financing is or is not negatively amortized. Now, these are, negatively, that's usually bad. But amortized is talking about the interest rate. When a loan is negatively amortized, you are not paying enough money monthly to cover the interest that's due every month. That's what negatively amortized means. So if the answer is, you might need to have a conversation with your buyer that they're not going to pay off this loan anytime soon unless they up their monthly payments. 99% of the time, the answer is going to be is not. Most people do not make mortgage payments so low that they don't even cover the interest. You know what kind of loans do get negatively amortized? Often student loans. So if any of you have student loans, those are usually negatively amortized because you are not paying enough every month to be able to cover just the interest, not even the principal. That's why it hangs on to you for so long. That's how that works. All right, on to page 2. We're almost done. These are just notes, okay? Notes about information based on mortgage assumptions. 44 and 45 on DVA, so a veteran's loan assumption. Seller's entitlement shall remain with the property unless the assuming buyer is a veteran and is approved by DVA to substitute buyer's entitlement or the loan is paid in full. This talks about that you have to be a veteran to be able to assume a veteran's loan. Now, some veteran loans, because there's multiple different kinds, don't require the buyer to be a veteran, but they do have other hoops they have to jump through. So make sure as the listing agent and the seller, you are talking to your mortgage company to see what requirements are needed to assume your specific type of loan. Okay. 46 and 47. On any mortgage assumption, seller shall remain liable for the mortgage obligation unless released from liability by DVA, FHA, and or the lender. Okay? When a mortgage is put on the property, that lien is recorded, right? And it's recorded in the seller's name. So what this is saying is that the seller will remain liable for that mortgage obligation if their lender uh doesn't allow release them from that obligation. What this is saying is that it is not our job as a real estate agent, it is not the buyer's job to get that release. This is a notice to the seller saying if you do not get that release from your mortgage company, you are still liable. That's just how liens work. Most of the time, when your seller is offering an assumptive loan, your buyer's getting assumptive financing. Part of that process and all of the paperwork is releasing the seller from their obligation to pay because the buyer then takes over. Okay. This is just a, hey, FYI, make sure that you're released as the seller. That's what this note is about. 48 to 49. For any FHA mortgage dated on or after December 1st, 1986, or DVA mortgage dated on or after March 1st, 1988, check with mortgage lender for assumption requirements. I don't know why this is there, to be quite honest, because you should always be checking with the mortgage lender for what the assumption requirements are. Okay. The next piece is the other category. You can put whatever other terms you need in relation to the assumption financing in here. Then everybody's got to sign, just like everything else. I th I hope that was clear for everybody in all of the pieces. Assumptive financing can be incredibly helpful depending on who you are and what you're doing. Oh, excuse me. If you have any questions, don't hesitate to reach out. We're more than happy to walk you through it on how you should fill these out. We have not had to do them until recently, which is why I wanted to bring you guys this video so that you had an idea of how to fill out the assumption financing addendum. We'll talk to you guys later. Thanks.